You're scrolling through your portfolio app, watching your stocks jump up and down after every earnings release, and you have absolutely no idea why. Apple beats expectations and drops 3%. Tesla misses and somehow rockets up 8%. You're not dumb, you just don't speak the language that actually moves markets. Here's what I've learned after years of decoding these reports. Your instincts about good versus bad earnings aren't wrong, they're just catastrophically incomplete. Hey, it's Ollie, and today I'm going to make reading earnings reports genuinely click for you. Here's the thing nobody tells beginners. Most people start with the headline number and wonder why they're confused. That's like trying to understand a movie by watching the last 5 minutes. Let me show you the story earnings reports actually tell. Imagine you're looking at Apple's latest quarterly report. Revenue hits $95 billion versus the expected $92 billion. That sounds amazing, right? But then you notice something weird, the stock drops anyway. That's because you're missing the other 90% of the story, and the smart money is reading things you haven't even heard of yet. But here's the beautiful part, once you know the framework I'm about to share, you'll never feel lost in an earnings report again. Every earnings report contains 3 financial statements, and each one answers a different question about the business. The income statement shows you the flow, how much money came in, revenue, how much went out, expenses, and what's left over, net income. Think of it like your personal budget, but for $1 billion company. The balance sheet is the snapshot, what the company owns, assets, versus what it owes, liabilities, at that exact moment in time. And here's the one most beginners ignore, the cash flow statement, which shows whether the company is actually collecting the money it claims to be making. I've seen companies report massive profits on the income statement while their cash flow shows they're hemorrhaging actual money. The difference between reported earnings and real cash flow? That's where you find the companies that are about to surprise everyone. Let me cut through all the noise and give you the 4 metrics that drive 80% of stock reactions. First, revenue growth, also called the top line. This shows whether the business is actually growing or shrinking. Second, net income, the bottom line, what's left after all the bills are paid. Third, earnings per share, or EPS. This is net income divided by the number of shares outstanding, and it's what analysts base their price targets on. Fourth, gross margin. This tells you about the company's pricing power and efficiency. Here's a concrete example. If a company reports $1 billion in revenue but only $50 million in net income, that's a 5% profit margin. Compare that to Apple, which typically runs 25% plus margins, and you start to see why some businesses are valued so differently. But there's one comparison that trips up even experienced investors, and I'll show you exactly what it is. Here's where most beginners get destroyed. They compare this quarter to last quarter instead of the same quarter last year. Imagine you're looking at a retailer's January numbers and comparing them to their December numbers. Of course, January looks terrible, December had Christmas. You always want to compare year over year, not quarter to quarter, because almost every business has seasonal patterns. A toy company will always crush quarter 4 and struggle in quarter 1. A tax software company will spike in quarter 1 and go quiet the rest of the year. When you see Tesla report quarter 1 deliveries down 8% from quarter 4, that might sound bad until you realize quarter 1 is always their weakest quarter historically. The smart move? Always look for the year-over-year percentage change. That's the number that tells you whether the underlying business is actually growing or shrinking. But even that number can lie to you if you don't understand the difference between revenue and earnings. Let's test this. Company A reports revenue up 20% year-over-year, but earnings down 15%. Company B reports revenue up 5%, earnings up 25%. Which company would you rather own? Take a guess before I give you the answer. Company B is almost always the better bet. Here's why. Company A is spending heavily to grow revenue, but they're not converting that growth into profit. That's a red flag unless they're a young company investing for the future. Company B shows pricing power and operational efficiency. They're squeezing more profit out of every dollar of sales. This is the classic revenue versus earnings dilemma, and it's why Amazon traded sideways for years while generating massive revenue growth but tiny profits. You don't need expensive Bloomberg terminals or Wall Street connections. Every public company files their quarterly report, 10Q, and annual report, 10K, with the SEC, and it's all free at sec.gov. Just search Edgar database with any ticker symbol and you'll find every filing going back years. These reports are filed in a format called XBRL, which means the numbers are standardized and searchable. No more hunting through PDFs trying to find the revenue number. Here's my process. I go straight to the 10Q, flip to the income statement, and pull revenue, net income, and EPS. Then I compare those numbers to the same quarter last year. Takes about 2 minutes once you know where to look. But here's what most people miss. The numbers themselves only tell half the story. Before every earnings release, Wall Street analysts publish their estimates for revenue, EPS, and other key metrics. When the company reports above those estimates, it's called a beat. Below the estimates? That's a miss. Sounds simple, but here's the twist. I've watched companies beat estimates and drop 10%, while others miss badly and rally 15%. The secret is guidance, the company's forecast for next quarter and the rest of the year. Investors don't buy stocks for what happened last quarter, they buy for what's going to happen next quarter. So when Apple beats current estimates but lowers their guidance for the holiday season, the stock sells off because the future looks dimmer than expected. When Tesla misses current quarter but raises full-year guidance, the stock rockets because the trajectory is improving. Always remember, Wall Street is a forward-looking machine, and guidance matters more than historical results. Now let me show you how to put this all together in a way that actually helps your portfolio. Here's your step-by-step process for the next earnings report you want to analyze. First, pull up the 10Q on SEC Edgar and find the 3 key numbers, revenue, net income, and EPS. Second, compare each number to the same quarter last year, not last quarter. Third, check if they beat or missed analyst estimates, but pay more attention to what management says about the next quarter. Fourth, look at gross margin trends. Is the company getting more or less efficient over time? Do this for 3 or 4 companies you're interested in, and you'll start to see patterns that most casual investors miss completely. Drop your first earnings analysis in the comments. I read them and I'd love to see what patterns you notice. The goal isn't to become a Wall Street analyst overnight, it's to speak the language that moves your money. Look, reading earnings reports used to intimidate me too. But once you realize it's just 3 financial statements telling a story about revenue, profits, and cash flow, it starts to make sense. You're not trying to predict the next Tesla, you're just trying to understand what you own and why it moves the way it does. That's the foundation of everything else in investing. If you want to go deeper into the advanced strategies the smart money uses, head over to nexusaicalls.com. Until next time, keep learning, keep growing, and remember, every expert was once a beginner who decided not to give up.